I was walking past a newsstand the other day, which, yes, apparently still exists, and I saw a magazine cover with a bull on it smashing through a wall of numbers.
Right.
And it hit me. For most of us, the stock market feels like this massive, exclusive club operating in a parallel dimension.
Mm-hmm. It's
Oh,
completely opaque.
totally. Everyone inside is wearing a bespoke suit, shouting into telephones, and speaking a language that sounds like English, but is actually some kind of, I don't know, arcane code.
Oh, absolutely. The yield curve inverted, the bears are capitulating.
The Fed is tapering.
Yeah.
And the rest of us,
Yeah.
we're just standing on the sidewalk, looking through the frosted glass, wondering what on earth is going on in there.
It creates a real sense of alienation, doesn't it? The financial world, I think, thrives on that jargon.
You think it's intentional?
To a degree, yes. It's almost designed to be a barrier to entry. If you make it sound complicated enough, people will just hand over their money and say, "You handle it, I'm clueless."
Clueless. That is exactly the word we are locking onto today. Because we're doing a deep dive into a book that tackles this head on. It's titled, If You're Clueless About the Stock Market and Want to Know More, by Seth Godin.
A fantastic choice. Godin has a real knack for simplifying complex things.
He really does. And look, the mission for this deep dive is simple, but it is huge. We want to take that feeling of being an outsider, that I don't belong in this club anxiety,
Yeah.
and completely dismantle it.
Precisely. Because the reality is the stock market isn't just a casino for the wealthy, and it isn't just a zigzag line on a graph on CNN.
Yeah.
At its core, it is a mechanism for ownership. And that is where we have to start. If you strip away the shouting traders and the high-speed algorithms, buying a stock is buying a piece of corporate America. It's about becoming an owner.
I love that framing. It changes the psychology from gambling on a number to owning a business.
It does. Godin makes this point very early on. He says that when you buy a stock, you become an owner. Someone who was, vilified by Marx but glorified by the American forefathers. You are moving from the labor class to the capital class, even if it's just with $100.
Right, but let's be honest, it's also someone who gets annoying phone calls at dinner from brokers trying to sell you the next big thing.
Well, yes. That is the downside of the industry, for sure. But let's unpack that concept of ownership, because it is the foundation of everything else we're going to discuss.
Okay.
We really need to understand the difference between renting and equity. This is a distinction that I think a lot of people understand intuitively with housing, but they fail to apply it to their investments.
Okay, so let's use the analogy from the text to ground this. If I rent an apartment, I'm paying for time.
Mm-hmm.
I get to live there for a month, I pay my landlord, and that's the transaction. At the end of the lease, I'll walk away. I have memories, maybe a few scratches on the wall, and if I'm lucky, I get my security deposit back.
But you've built nothing.
I leave with zero value.
Correct. You have no equity. You have no stake in the asset. If the property value triples because the neighborhood becomes trendy, your landlord celebrates.
I just get a rent hike.
You just get a rent hike. You are paying for a service. But if you buy a condo,
Then I'm an owner. I have equity.
yes, and equity is just a fancy word for ownership stake. It means your financial future is tied to the value of that asset. Buying a stock is exactly the same principle.
I'm buying a piece of the building.
You are buying equity in a business. You are a partial owner. Now, admittedly, you are a very small owner.
Right. I can't exactly walk into the boardroom of Apple or Microsoft, slam my fist on the table, and demand they put better snacks in the cafeteria.
No, you can't. But the financial principle remains the same. You are participating in the growth and the risk of that entity.
Okay, so that's the what. But I want to understand the why. Why does this system even exist? Why do companies sell off little pieces of themselves to strangers?
To understand that, we have to look at the Joe's Pizza analogy from the book. It's a brilliant illustration.
So we have to talk about Joe, because Godin uses this pizza shop analogy that honestly explains the entire global economy in about 3 pages.
It really does.
But I want to push back on one part of it, see if we can get to the bottom of the why.
Now let's dig in.
Okay, so Joe has the skills, the amazing recipe, the drive. But he's broke. He's run out of savings. He needs an oven. He needs to run ads. So he goes to the bank.
The logical first step.
And the bank shuts him down. And usually we frame this in movies as evil banks versus the little guy.
The classic narrative.
But we look at this through the lens of risk. The bank is being completely rational, aren't they?
Oh, absolutely. And this is a crucial distinction for the listener. The bank is in the business of renting you money. That's it.
Right. Renting, not owning.
They don't care if Joe becomes the pizza king of New York. They just want their 5% interest.
Exactly. Their upside is capped. They can never, ever make more than that 5%. So why would they accept the massive risk that Joe might burn the place down or just make terrible pizza?
They wouldn't. This is what financiers call asymmetric risk. The bank has limited upside and total downside. If Joe goes bust, they lose their principal.
They lose everything.
But if Joe succeeds wildly, they just make their tiny bit of interest. The risk-reward calculation just doesn't work for them. So for a startup like Joe's with no track record, the bank says no.
So Joe is stuck.
He's stuck. He has to find a partner who is willing to take on that total downside risk.
And the only way to lure that person in, that partner, is to offer them something the bank doesn't get.
Unlimited upside.
The lottery ticket.
Exactly, which is where the friends come in. This is the birth of the stock market right here in this little pizza shop. It's not about charity.
No.
Joe goes to his buddies and says, look, I can't give you collateral. I can't promise you interest payments because I have no cash flow yet. But I can give you a lottery ticket that I can influence.
A lottery ticket you can influence. I like that. He's not just handing them a slip of paper and wishing them luck. He's the one running the machine.
Yes. He offers equity. He says, give me $5,000 for the oven. If I fail, you lose it all. It goes to zero.
Yeah.
But if I turn this into the next dominoes, that $5,000 becomes $5 million.
It's a completely different proposition. You're not a lender anymore. You're a partner. You're an owner.
You're an owner. You share in the risk, and you share in the reward.
But here's my pushback. It's the most expensive money Joe will ever take, though.
Most people think it's free money because he doesn't have to make monthly payments. There's no interest clock ticking.
But he's giving away the future. If he actually does become Domino's, he just sold a massive chunk of his empire for the price of a used sedan.
That is the tragedy and the beauty of it. It is the most expensive capital, but only if he succeeds.
Oh, that's the key.
If he fails, it was free money. His friends got nothing, and he just walks away from the debt. And that trade-off, selling a piece of your dream to fund the reality of today, is literally what an initial public offering, an IPO, is.
It doesn't matter if it's Joe's Pizza or Facebook going public.
The mechanism is the same. Companies sell stock to finance growth when debt isn't the right fit or just isn't available. They're trading a piece of the future for cash right now.
So when we buy a share of stock on our phone, we are basically being one of Joe's friends. We are giving capital to a company in exchange for a ride on their rocket ship.
Or their sinking ship.
Right. Safety belts required. And maybe a helmet.
Definitely a helmet.
Which brings us to the next big question. Okay, so we own the stock. We're on this ship. How do we actually make money? Because I think for a lot of people, they just see a number on a screen going up and down. It feels abstract.
It does feel abstract, but there are really only two actual mechanics of profit here.
Okay.
There are two main avenues. The first is what we just described with the pizza example, capital gains.
The classic buy low, sell high.
Simple as that. You buy the stock at $10, the company executes its plan, sells more pizza, opens more stores, and becomes more valuable as a business.
And the market eventually recognizes that value.
Right. The market isn't always rational day to day, but over time, value tends to win out. So the stock is now worth $20. You sell. That $10 difference is your capital gain.
So you are profiting from the increase in the valuation of the enterprise itself.
Precisely. That's avenue number one.
But there's a second way, right, which is more like, I don't know, getting a paycheck for owning the stock?
Yes, dividends. Now, this is important to distinguish. Not every company pays dividends. Going back to Joe in the early days, if Joe makes a $1,000 profit in his first year, what is he going to do with it?
He's definitely not giving it to his friends.
No way.
He's probably going to buy a second better oven, or run more ads, or maybe fix the leaky roof.
Exactly. He reinvests it to grow. This is typical of what we call growth stocks. Young, aggressive companies. Think of Amazon for its first 20 years, or Tesla. They rarely pay dividends.
Why?
Because they believe they can get a better return on that dollar by investing it back into the business than you could. They need every single penny to expand and capture the market.
Okay, that makes sense. But what about older, bigger companies?
Right. Let's say Joe has been in business for 30 years. He has a chain of Joe's Pizza stores all over the country. He dominates the market. He doesn't need to build 500 new ovens this year. He has steady, massive profits and nowhere to efficiently spend all of them.
So he decides to reward the people who backed him all those years ago.
Correct. He distributes a share of those profits back to the owners, the stockholders. That is a dividend. It's a reward for loyalty and ownership in a mature, stable company.
So it completely changes why you might own that stock.
It changes the investment profile entirely. You aren't just hoping the stock price goes up, you are getting a quarterly check just for holding it. It's a stream of income.
So you have growth versus income, capital gains versus dividends. But underneath all of this, whether a company pays dividends or reinvests for growth, there is one engine that drives everything. And Godin spent some time on this. Cash flow.
The lifeblood of business. You can fake profits for a while with accounting tricks, but you can't fake cash.
He uses a great analogy here, the tide.
Yes, cash flow is the ebb and flow of the ocean. Money comes in from customers, the tide comes in. Money goes out to pay for salaries, rent, materials. The tide goes out. As long as the tide comes in more than it goes out, your boat stays afloat.
Simple enough. But Godin uses a case study here that sounds ridiculous at first glance. The Wacky Widgie Company.
It sounds like a cartoon, but it's actually a horror story.
Yeah.
And it happens constantly in the real world.
So lay out the nightmare scenario for
Okay. You have a company making these wacky widgets. The public loves them. They are flying off the shelves. Sales are doubling every month.
The story sounds amazing.
It does. If you looked at a chart of the revenue, the top line number, it's a hockey stick going straight up.
And if I'm a clueless investor, I'm looking at that revenue chart and screaming, buy, buy, buy. This is the next big thing.
You and thousands of others. But you forgot to check under the hood. You forgot to look at the cash flow.
And what's happening there?
They sell the widget for $1, but it costs them $2 to make it, package it, and ship it. They lose $1 on every single sale.
The classic, we lose money on every unit, but we'll make it up in volume fallacy.
The most dangerous fallacy in business. And Godin's point is that cash flow is gravity. You can defy gravity for a while if you have enough hype.
How so?
Investors will keep throwing money at you to cover the losses because they believe in the growth story. They think, oh, once they get to scale, they'll figure out how to make it for 50 cents.
We saw this with the dot-com bubble. We saw this with WeWork more recently. Companies with massive top-line growth, but a terrifying bottom-line reality.
They were burning cash to acquire customers, hoping that one day the math would flip. But eventually, the music stops.
The tide goes out.
The tide goes out. When investors stop subsidizing that $2 cost, the company is left naked. It doesn't matter how popular the product is. If the math doesn't work, the company goes belly up, like a beached whale.
So the lesson for the listener isn't just check the profit. It's don't be seduced by popularity. Just because everyone you know is using an app or wearing a brand doesn't mean the company is actually making money.
Profitability is the only thing that sustains a stock price in the long run. Everything else is just marketing and sentiment.
So we've got ownership, we've got the mechanics of profit, and we've got the critical warning about cash flow. I want to shift gears and talk about the experience of being in the market.
The psychology of.
Exactly. Because Godin paints a very vivid picture of what a stock chart actually looks like. He compares it to a roadmap.
Yes. He says a stock chart isn't like the straight, endless roads of Death Valley where you can see for miles and nothing changes.
Which would be nice, but no.
No, it's like the Pacific Coast Highway in California.
Twists, turns, hairpin bends, spikes, sudden drops, a total roller coaster.
Yeah.
And sometimes the fog rolls in and you can't see 5 feet in front of you.
And that volatility, that up and down motion, is where most investors get hurt. Not because the market is rigged, but because their own psychology works against them.
This is the danger of short-term thinking.
The biggest danger of all. Godin talks about the quarterly trap.
Explain that.
Public companies are legally required to report their earnings every 3 months a quarter. It's a very, very short amount of time in the life of a real business.
Right.
But the market, and especially the financial media, often reacts violently to these reports. A company misses its earnings target by a single penny. The stock might drop 10 or 20% in a day.
And the instinct for the individual investor, seeing their account balance plummet, is to panic. Abandon ship, the line is going down.
But that is almost always a mistake. A bad first quarter doesn't mean a bad decade. If you owned Joe's Pizza and he had a bad month because the road was under construction and fewer people came in, would you sell the whole business?
No, of course not. You'd know it was a temporary setback.
Exactly. But with stocks, we don't have that context, so we panic. Godin emphasizes that long-term is measured in years, not months. If you bounce in and out of stocks based on what happened in the last 3 months, you are trying to predict the future.
And spoiler alert, You can't.
You really can't. There's this fantasy of market timing, this idea that you can be clever enough to sell right at the very top peak and buy back in right at the bottom trough. It's the holy grail of investing.
Does anyone ever actually do it consistently?
No,
Mm.
nobody. Even the legends fail at it. Usually what happens is you sell when you get scared, which is typically near the bottom, and you buy when you get greedy and feel like you're missing out, which is usually near the top.
So you end up doing the exact opposite of buy low, sell high.
You end up missing the gains and hitting all the losses. It's a recipe for disaster.
So the rule of thumb here is patience.
Mhm.
You need a strong stomach, a very strong stomach.
You must master your emotions. Fear and greed are the two drivers that steer investors off a cliff. Warren Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful."
Easier said than done.
Much easier said than done. But the long-term investor puts on the blinders and looks at the horizon, not the potholes directly in front of the car.
I like that. Eyes on the horizon. Now, speaking of looking back to see where we're going, I want to pivot to the geography of this because I think it explains the psychology. We say Wall Street today and we think of glass towers, air conditioning, and guys in those Patagonia vests.
Right, the modern image.
But Godin takes us back to the literal roots. And it was a lot dirtier.
It's a great reminder. Wall Street isn't a metaphor. It was an actual physical wall.
1653. We are talking about a dirt path running alongside a 12-foot wooden barricade on the edge of the Dutch settlement of New Amsterdam.
That's right, a palisade made of sharpened logs. On one side, you have the civilized settlers and their businesses. On the other, the wilderness, the British who were a constant threat, and the Native Americans. It was a defensive fortification.
And in the shadow of that wall, people started trading.
It was messy, it was loud, it was outdoors. It probably smelled like the harbor and unwashed wool and livestock. This was not a refined place.
And it stayed that way for a long time. Even after the wall came down, the culture of the wall remained. The insiders versus the outsiders.
That's the key thread that runs through the whole history. Fast forward about 140 years to 1790.
The birth of the U.S. market.
You have the first real spark of a U.S. stock exchange in Philadelphia, not New York. And it was driven by government bonds.
To pay for the Revolutionary War.
Exactly. The government was broke and needed to raise money, so they issued debt. People bought and sold these bonds. That was the first real market. But the real culture shift happens in 1792 back in New York.
The famous Buttonwood Agreement.
Yes. You have 24 prominent brokers. They aren't in a boardroom. They aren't in a fancy building. They are standing under a buttonwood tree, a sycamore on that same dirt road, Wall Street.
And they signed this pact, which sounds very official, but reading about it, it was basically a cartel, wasn't it?
It was absolutely a cartel. It was a classic price-fixing scheme. The agreement said two simple things. One, we only trade with each other. We're cutting everyone else out.
Creating the in crowd.
And two, we all charge the public the exact same, very high commission.
So let's stop cutting each other's throats on price and start squeezing the customers together.
Precisely. And that handshake under a tree created what became the New York Stock Exchange, the NYSE. It institutionalized the idea that we are the club.
Mm-hmm.
If you wanted to trade the respectable companies, the big banks, the government bonds, you had to be under the tree or later inside the building.
But what I love about this history is that the market hates a vacuum. It hates exclusivity. The Buttonwood guys were snobs. They wouldn't touch the new risky stuff.
No way. Later on, when the Industrial Revolution hits in the 1800s, you have these crazy new startups building railroads and factories and steel mills.
Things we think of as pillars of the economy now.
Right, but back then the NYSE looked at them and said, that's speculative gambling. We don't touch that. It's too volatile, too new.
So where did those companies go to raise money? They went right back outside?
Literally into the rain and the snow and the mud. They were called the curb exchange. These brokers stood on the curb outside the nice, warm NYSE building.
That's incredible.
They wore bright colored jackets so they could signal to clerks who were watching from the windows of the buildings above. They developed a whole system of hand signals to communicate trades because it was too loud to shout over the wagons and the crowds.
It's like a whole separate scrappy ecosystem.
It was. And this curb exchange, the home of the rejects and the rebels, eventually got so big they had to move indoors. And they became the Amex, the American Stock Exchange.
An institution in its own right, born out of being excluded from the first institution.
Correct. And this pattern just repeats itself over and over. Fast forward to 1971. You have a new breed of companies' technology. Intel, Microsoft, Apple,
The garage startups?
The garage startups, the establishment, the NYSE didn't really know what to do with them. They didn't have the long profit histories. So they didn't go to a physical trading floor.
They went to a computer network.
I went to a computerized network called NASDAQ, the outsider again. And now, of course, NASDAQ is home to the biggest companies on the planet.
It's really an ecosystem of outsiders becoming insiders. The curb became Amex. The computer network became the home of trillion-dollar companies.
It is. And it's important to know this because it helps you understand the different venues you hear about. The NYSE is the old guard, the auction house. NASDAQ is the digital dealer network. But today, for you and me sitting at home, it all happens on a screen. The history is still there, but the execution is instant.
Speaking of us sitting at home, let's talk about the players in this game today. Because if you are clueless and you walk into this, you need to know who is taking your order. Godin breaks down the broker types, and I think this is crucial because fees can eat you alive if you aren't careful.
Absolutely. Fees are like termites in your financial house. You don't see them, but they're doing damage. At the top of the food chain, cost-wise, you have the full-service brokers.
This would be the Merrill Lynch, the Morgan Stanley of the world.
Exactly. These are the hand holders.
What do you mean by that?
You pay high fees, high commissions, but in exchange, you get research, you get advice, you get a financial plan, you get someone to call you on your birthday and talk you off the ledge when the market drops.
You're paying for a relationship and guidance.
You are. Then you have the next tier down, the discount brokers.
Companies like Charles Schwab or Fidelity.
Right. Cheaper trades, less advice. You are doing more of your own homework. They provide the platform, the tools, the research, but you are the one driving the car.
Which is great if you know how to drive.
It is. And then you have the bottom tier, the deep discount brokers.
That's bare bones.
Totally bare bones. Strictly execution. You call an 800 number, or more likely now, click a button on an app, and they buy the stock for you. No advice, no hand-holding, but very, very low fees.
So if you know exactly what you're doing, this is the most efficient. But if you don't...
It's just a cheaper, faster way to make a mistake.
Now, there are some other characters in the background, too. Godin mentions specialists and market makers. These aren't people the average Joe talks to, but they keep the machinery running, right?
Right. Think of them as the brokers to the brokers, or maybe the air traffic controllers of the market. Their main job is to provide liquidity.
What does that mean, liquidity?
It means making sure that you can always buy or sell when you want to. Imagine a piece of bad news comes out about a company. Everyone wants to sell their stock at the same time, and nobody wants to buy it.
A panic.
A total panic. In a truly free market with no backstop, the price would just fall off a cliff. It would go to zero instantly because there are no buyers. A specialist or market maker is obligated to step in.
They have to buy.
They have to provide a bid. They have to buy when no one else will to maintain an orderly market. They smooth out the volatility. They make their money on the spread, the tiny difference between the buy and sell price. But their function is to make sure there is always a buyer for every seller and vice versa.
So they're like the shock absorbers.
That's a great way to put it.
But not everyone in the ecosystem is there to help you smooth things out. We have to talk about the sharks, because Godin has a whole section on swimming with sharks.
And for good reason. The market involves huge sums of money, and money attracts predators. And if you are clueless, you look like lunch. You're the chum in the water.
So what are the big scams or traps we need to watch out for? What does a shark look like?
Well, one of the classic ones, especially with less ethical full-service brokers, is churning.
Churning. It sounds unpleasant.
It is. It happens with brokers who are paid on commission.
Meaning they get paid every single time I make a trade,
Yeah.
buy or sell.
Exactly. Whether you make money or lose money on that trade is irrelevant to their paycheck. They get paid for the transaction itself. So a dishonest broker might encourage you to buy and sell constantly.
Hey, I've got a great idea for you. Let's sell that stock we bought yesterday and buy this new one.
Right. Buy this, now sell it, now buy this other thing. They aren't trying to build your wealth. They're trying to generate fees for themselves.
That's insidious.
It really is. If a broker makes $150 in commissions in 2 days on your account, they had a great week. You might have just lost money on spreads and small losses, but they got their paycheck.
That's nasty. But there's another one that feels even more predatory. Price manipulation. The pump and dump.
This is pure fraud. It usually happens with what are called penny stocks.
Stocks that trade for pennies. Literally. 10 cents, 20 cents a share.
Exactly. These companies are usually tiny, with very little public information available. They are what's called thinly traded, which is a key part of the scam.
What does thinly traded mean?
It means not many shares are bought or sold each day, so it doesn't take much money to move the price dramatically. You or I couldn't move the price of Apple. But with a penny stock, a few $1,000s can make the price double.
Okay, so the scammer, the shark, takes advantage of that.
Yes, the shark buys a bunch of shares at, say, 10 cents, a million shares for $100,000. Then they go to work.
The pump.
The pump. In the old days, it was boiler rooms with guys cold calling people. Today, it's internet forums, social media bots, spam emails. This company found gold in Nevada. This company has a secret cure for the common cold. They pump up the hype with lies.
And the clueless investors see the price start to tick up because the shark's friends are also buying. They think, oh, this is it, the rocket ship. I'm getting in on the ground floor.
So they rush in. Their buying frenzy drives the price to 20 cents, then 30 cents. The hype becomes a self-fulfilling prophecy for a moment.
And then the shark sells.
The dump! They unload all their shares at the high price, taking a massive profit. The sudden, huge selling pressure crashes the stock. The rumors turn out to be false. The price falls back to 5 cents or less.
And the shark walks away rich.
And the innocent investors who bought at the top are left holding worthless stock.
And the defense against this. How do you protect yourself?
Skepticism. Gurdon says it perfectly. Knowledge is power. If a deal sounds too good to be true, it is. If someone is screaming at you to buy a stock that costs less than a gumball, ask yourself, why are they sharing the secret with me?
Right. If it was such a sure thing, they'd just keep to themselves.
Exactly. Usually it's because they need you to buy so they can sell. The best defense is to stick to well-known companies and ignore the hype.
Don't just follow the hype train. Okay, I want to zoom out. We've looked at the players, the history, the mechanics, and the scams. But the stock market doesn't exist in a vacuum. It's tied to the economy. And I think people often confuse the two. They think the stock market is the economy.
It's a very common confusion. They are related, but they are not the same thing. It's a symbiotic relationship.
How so?
The stock market is a barometer. It's a forward-looking machine that tries to guess what will happen in the future. But the economy is the weather. It's what's actually happening right now. The market predicts the weather, but the economy is the weather.
I like that. So how does the connection work? Let's trace the chain reaction from my wallet to Wall Street.
Okay. It all starts with disposable income. If the economy is good, if unemployment is low, people have jobs. They get a paycheck, they pay their rent, they buy their food, and hopefully they have money left over. That's disposable income.
That's the fun money.
The fun money. So they go buy toys, wacky widgets, new cars, the latest iPhone. They go out to eat at Joe's Pizza.
When people buy things, companies make revenue.
And if they're well run, they make profits. Corporate profits go up. When profits go up, the company is fundamentally worth more, so stock prices generally go up. It's a virtuous cycle.
And the reverse is the downward spiral.
Exactly. High unemployment means no disposable income. People stop buying toys. They only buy the essentials. Retail sales drop. Corporate profits drop. Companies, to save money, lay off workers.
Which makes unemployment even higher.
It feeds on itself. This is a recession.
Now, there is one force that acts like gravity on this whole system. We touched on it briefly with the bank, but we need to go deeper. Interest rates.
The most important number in finance. It is the price of money.
Why are high interest rates so bad for the stock market? I feel like I hear that on the news all the time. The Fed raised rates, stocks tumbled. Why? What's the direct connection?
It's a double whammy. There are two big reasons. First, there's the internal cost to companies. Companies borrow money to expand, to build new factories, to do research. If interest rates are high, borrowing is expensive. So they do it less. They expand less, they build fewer factories, they hire fewer people. Growth slows down across the board.
Okay, that makes sense.
Yeah.
Expensive money means less growth. What's the second reason?
The second reason is competition for your investment dollars. This is the part people often miss.
Okay.
Let's say I can go to the government and buy a risk-free treasury bond that pays me 10% interest, guaranteed by the full faith and credit of the United States.
The safest investment on the planet.
The safest investment on the planet. If I can get a guaranteed 10%, why on earth would I take the risk of buying a stock, which could go down?
You wouldn't. Or you demand a much, much higher potential return from the stock to make it worth the risk.
Exactly. High interest rates make safe money attractive. So investors pull money out of the risky stock market to put it into safe bonds. That selling pressure drives stock prices down.
And the reverse is also true.
The reverse is what we've seen for much of the last decade. When interest rates are near zero, savings accounts pay nothing. Bonds pay nothing. You have to put your money in stocks to get any kind of return. That flood of money drives the market up.
That is such a clear explanation. It really helps to visualize the economic cycle, too. Godin describes it as a wave.
It's a perfect analogy. The wave has phases. You have the peak, then a recession, then the trough, a recovery, and finally expansion, which leads to a new peak.
And the psychology during these phases is fascinating because it is almost always wrong.
It is usually dead wrong. Human emotion is a contrary indicator. At the peak, the economy is booming. Everyone is optimistic. Everyone thinks it can't go downhill from here. This time is different.
Their taxi drivers giving you stock tips.
That's the classic sign. Companies raise prices because they can. Confidence is sky high.
But that's exactly when the slide begins. The bubble bursts.
Yeah. And then you go into the slide, into recession, and you hit the trough. The bottom, things look bleak. The news is terrible, unemployment is high, everyone is pessimistic. They think it's never going to get better, the system is broken.
But that is actually the best time to buy stocks.
Historically, yes. That is the point of maximum opportunity. Just as the recovery begins, stocks are on sale. But Godin warns, and this is critical, timing this is impossible without being psychic.
Why?
You never know you're at the trough until you look back 6 months later and see the market is up 20%. In the moment, it feels terrifying. If you try to catch a falling knife, you usually get cut.
Speaking of getting cut and looking back at history, we can't do a deep dive on the market without acknowledging the scars, the big stock moments that define generations of investors.
We absolutely have to talk about Black Monday, October 19th, 1987.
I was looking at the notes on this. The market fell 508 points in a single day.
Which doesn't sound like a lot now, but that was 22% of its value.
22%.
Gone. In one trading session, imagine losing nearly a quarter of your entire life savings between breakfast and dinner.
What caused it?
It wasn't caused by a war or a plague. It was panic, pure and simple. But it was exacerbated by the new computer trading programs of the time, which just kept selling automatically as the market fell, creating a vicious cycle.
It's a reminder that the risk is real. It's not just a line on a chart. It's people's futures.
It is. But then look at the even bigger one, the 1929 crash. The start of the Great Depression. The market was decimated. People lost everything. But here's the statistic from the book that blew my mind.
Okay.
It took until 1954 for the Dow Jones Industrial Average to pass its pre-crash high from 1929.
Wait, say that again. 1954.
1954.
That's 25 years later.
A full quarter of a century. That emphasizes the long term. We are used to markets bouncing back in a year or two now, but sometimes it takes a generation.
And that's why.
That is why money you need for rent next year or for your kids' college tuition in 2 years should never, ever be in the stock market. You might not have 25 years to wait for the recovery.
That is a very sobering thought. But it's not all just guesswork and gambling. There's a dashboard we can watch, right? Indicators.
Yeah.
If we want to be less clueless, what should we be looking at besides the stock price itself?
Yes, there are vital signs for the economy. Smart investors watch the GDP or gross domestic product.
Which is the total output of the entire economy.
Right, all the goods and services. If that's growing, generally businesses are healthy. That they also watch the CPI, the Consumer Price Index.
Inflation.
Exactly. The cost of living. If that goes up too fast, it erodes your buying power, and it usually means interest rates will have to go up to fight it, which, as we discussed, is bad for stocks.
And there's one more weird one Godin mentions, housing starts.
Yes.
Yeah.
Why that one? What do you think?
Well, I assume because building a house is a huge long-term commitment. You're not just buying a coffee. You're betting on the future of a neighborhood, of a city.
Exactly.
Yeah.
You don't break ground on a new subdivision of 100 homes if you think a recession is coming next month and no one will have jobs to buy them. If builders are starting new homes, it's a massive sign of confidence in the future.
So it's a leading indicator.
It's a classic leading indicator. It tells us what smart people with a lot of money on the line think is going to happen next.
So we've covered a lot of ground here. We've gone from Joe's Pizza and the cost of equity to the dirt roads of early Wall Street to the nightmares of wacky widgies and the Great Depression. As we wrap this up, I want to touch on the philosophy of it all, because Godin ends with a reflection on capitalism itself.
He does. He quotes a definition of capitalism as An economic system based upon the continuous and unbridled pursuit of capital.
Unbridled pursuit. That sounds aggressive,
That's what
almost dangerous.
it sounds a bit like greed, doesn't it? And Godin acknowledges that. The system has sharks. It can be cold. It punishes bad math and bad ideas ruthlessly.
As we saw with the wacky widgies.
Exactly. But he argues that historically, this mechanism, this ability for a Joe with a good idea to get money from strangers to build a dream, is the most efficient engine for wealth creation and raising the standard of living we have ever created.
It works.
Yeah.
Despite all its flaws, it works. It connects wars in the Middle East, oil prices, your neighbor's job, and your retirement fund into one massive, messy, productive web.
And you don't have to be a shark to swim in it. You just have to be smart. You have to be informed. You have to understand that the market isn't a magical money machine. It's a reflection of real businesses trying to grow and create value.
So the final takeaway for our listener, the clueless learner we started with, what's the one thing they should remember?
Stop looking for a lottery ticket. Stop listening to the guys screaming on TV about what the market will do tomorrow. Start thinking like an owner of a business. Be patient. Check the cash flow. And mostly, master yourself.
That's where I want to leave it. A provocative thought for everyone to chew on. If the market is just a reflection of collective human behavior, all of our greed, all of our fear, our moments of genius, and our moments of panic, does mastering the market actually require mastering the math? Or does it require mastering yourself?
That is the million-dollar question, isn't it?
Thanks for diving deep with us today. We'll catch you on the next one.